This is the Millennials in Multifamily Podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Hey everyone, and welcome to another episode of the Millennials in Multifamily Podcast. I'm your host, John Stober, with my co-host, Fritz Ritter, and today our guest is none other than Yonah Weiss. Yonah is a powerhouse with property owners' tax savings. As business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars of taxes through cost segregation. He has a background in teaching, a passion for real estate, and loves to help others. He's also a real estate investor himself and host of his very own podcast, Weiss Advice.
Yonah, thanks so much for joining us on today's show. Could you just give our listeners a little bit more background on yourself and how you became the cost segregation expert you are today?
Yeah, absolutely. So I have my background in teaching. I started as a teacher for many, many years and got involved in real estate just about 5 years ago. And many different hats. I was a commercial mortgage broker. I was a residential real estate broker. And then I really just wanted to get involved in investing. And so I wanted to learn everything there was to know about commercial real estate. And, you need to pay the bills also. And I found this wonderful company, Madison, that I work for. And they're really the experts, cost segregation. Okay. They've been in the business for decades and have been literally, we're the biggest company in the United States doing this in all 50 states. The accountants, the CEO, the CPAs, all of them that are involved in the daily activities of the company are the real experts. So I'm really just very good at teaching, okay? And I learn from them very quickly, and I like to be kind of the face of the company. So it's been my pleasure to kind of spread the word on podcasts like this and share the knowledge. But at the end of the day, if I did not have that expert team of over 60 in-house engineers and accountants and whole operations teams actually doing the work, then I would just be, a guy standing on a soapbox.
Well, so it sounds like there's a lot of moving pieces with this. Could you just take a second to explain to our listeners what exactly is cost segregation?
Sure. It's a way of depreciating a property at a faster rate, a more advanced way of depreciating a property. So if you think about depreciation, right, which is one of the greatest tax benefits the government gave to commercial property owners, it allows you to literally write off the property as a tax write-off.
Why isn't every real estate investor conducting cost segregation on all of their properties?
So a lot of the real savvy ones are, okay, and people who have been in the business for years and been in commercial real estate for years definitely are, for the most part. It's really people like you and I who are starting out and trying to get, maybe a lot of the listeners out there are trying to get involved in their first properties. You never knew about cost segregation before. And you assume that since it's a tax thing, your accountant is taking care of it. But the truth is, accountants don't do this. Accountants can't do this. You need engineers. You need actual specialized engineers to conduct the cost segregation. Not only that, the accountants in many instances, in my experience, are not proactive enough in actually even telling their clients about this. So not only are they not educating them, but they're not even telling them that they should look into doing this. So that's really what is stopping people from doing cost segregation, is just the lack of knowledge.
What type of investor would cost segregation benefit the most?
Who's going to benefit the most is someone who is, by definition, a real estate professional. Okay, by IRS terminology, that means someone who's involved with more than 50% of their time in the real estate trader business, whether it's brokering, constructing, managing, any of those type of things that are involved in the actual real estate business. They're going to be the biggest beneficiaries of cost segregation because of an incredible rule that allows them to actually take write-offs from depreciation to write off their entire income, their active income as well. Just so I can clear that up and what that means, depreciation, just take a step back. We talked about how awesome it is. It's this huge deduction, great thing. However, it's considered a passive loss, okay, a passive deduction, which can be used against passive income. Okay, so passive income is coming from your property. Okay, if you have property, real estate is considered passive income. So depreciation, deduction, you can offset passive income. You make $100,000 from your property, you have $100,000 of deductions, you wash it off, you walk out with $100K in your pocket. Okay, that's how it works. However, the depreciation cannot be used, or in limited cases, but cannot be used against any of your other active income. So let's say you're a W-2, you have a job, and you also have some real estate investments, okay, some properties, but you're not a real estate professional. The depreciation or the cost segregation, which creates huge depreciation deductions, is only going to be limited to the amount of income from the property. It's not going to spill over. However, if you are a real estate professional, it's literally going to spill over. So if you make $100,000 from your property, you have $100,000 depreciation, that's great. But let's say you have $100,000 from your property and $1 million of depreciation deductions. So the $100,000 is going to be washed off, and the other $900,000 of deductions will not be utilized. Will just be called a passive loss and will carry forward. You could use it next year. Okay, that's for a regular person. But a real estate professional can now take those extra $900,000 of deductions and use that against any other income. So let's say you made $1 million if you're a real estate professional. Let's say you have brokering and you're making deals, you're getting commissions from brokering, okay? That's the perfect job to also invest in real estate, because now you can use that $900,000 of deductions and wash off your $1 million of real estate brokering commission income and pay little to no taxes.
So for those limited partners that are not real estate professionals, let's say like doctors, attorneys, is cost segregation really that beneficial for them, or would they rather invest in a regular deal that's not doing cost segregation?
I think it's very beneficial for them specifically because it allows you to have the passive income coming from your properties tax-free, okay, over those first 5 years. So essentially what we're doing is investing in a deal and we're getting a 8%, 10%, whatever it is, return per year, okay, but then you're going to have to pay tax on whatever income you make. Okay, but if it's being cost segregation deal where you're getting so many tax deductions that over the first 5 years, you're literally not going to pay taxes in many cases on the income produced from those passive investments.
So I'm also wondering, what type of tax planning does an investor with a limited partner who's not a real estate professional and someone who is a real estate professional, what type of planning do they need to do when they're entering a deal with cost segregation? Because the depreciation recapture is going to be a lot higher, is it not?
There is significant, obviously the tax planning is going to be an important strategy over here. And you raise a great point about depreciation recapture tax. It's not necessarily going to be more significant because they're doing the cost segregation, which is a common misconception. Number one, let's get rid of the first misconception, is that what is depreciation recapture tax in the first place? Okay, so depreciation recapture tax does not mean that you have to pay back the depreciation. Okay, it means that you have to now pay a tax on the amount of depreciation that you took. Okay, however, that tax is, number one, less than your ordinary income tax rate. Okay, number two, by doing a 1031 exchange on the sale, which would go into your category of that kind of tax planning, that strategy, you're going to be able to further defer that depreciation recapture tax along with the capital gains tax. Okay, so that's another great thing to keep in mind when you're talking about the tax planning. The third thing is that when you're dealing with what we call partial asset disposition, okay, and this is getting a little deep, but it's an important aspect to understand to get rid of this misconception, which a lot of people use this strategy when the selling of the property and you have already done cost segregation. Okay, so partial asset disposition is a form that you will file on the sale of a property that allocates a certain amount to the land, okay, allocates a certain amount to the personal property and things that have been deducted or have been written off already. So what cost segregation is doing, we're taking 5-year property, we're taking property, personal property, furniture, fixtures, carpeting, cabinets, anything that's in the property, not part of the structural components, you're writing that off on a 5-year schedule. After 5 years, guess what? You've just told the IRS this stuff has no more tax value to it. If it has no more tax value, it's already been written off, its basis has been lowered, therefore, you're not going to have to pay recapture tax on that amount. Okay, you're only going to pay recapture tax, the 25%, on the remaining amount, okay, which you would have had to pay anyways, regardless of whether you do cost segregation or not. So again, you're getting the benefits up front, the time value of money, and you're able to now use that money to reinvest. And on the end, you have strategies around dealing with the recapture tax if you do want to mitigate that.
That's awesome. So besides the 1031 exchange, any other strategies investors can use to utilize the impact of depreciation recapture?
Well, I think what we just discussed, which was exactly that. So that's the partial asset disposition. That's probably the biggest strategy that's out there. There are other strategies, and again, it's really not our topic, but there's certain things like conversion easements, which make people want to do. Obviously, giving charity is a great way, right? You get tax write-offs that way. But no, the real strategy, like I said, is getting around that, is further deferring those taxes or finding a way not to even pay the tax on the cost segregation with the partial asset disposition. Or alternatively, if you're a real estate professional and you have another property, let's say you've bought another property and you've created with the bonus depreciation a huge amount of depreciation on the new property, and you have a sale simultaneously in the same tax year, and you're hit with depreciation recapture, you can use the extra bonus depreciation to offset the recapture tax as well. So there's a hierarchy of what it's used for, but as long as you have enough left over after any other deferred gains, you can actually use that to offset the recapture tax.
So you said at Madison you have 60 people, CPAs, engineers. Could you just outline exactly what is the process of cost segregation from start to finish, and where do all those different players come in to the study?
Sure. So the first thing we'll do is you'll reach out if you want to get a free estimate. So we provide a free estimate all the time for any property, which will allow you to see up front at no cost what are my potential tax benefits if I go ahead and do a full cost segregation study. And so our engineers go ahead and produce that report. It's a couple pages kind of analysis based on some vital information on the property. Once you decide to go ahead and engage us or a firm, a cost segregation firm with the study, we will send an engineer to the property. Okay, it's required. They need to actually walk the property, take pictures, measurements, do a site visit. We'll come back and start to prepare a report. Okay, the report is the engineer finding every single detail of the property, breaking it down into those different lives, different categories. It's crazy, like 90, 100 pages long report of calculations and a lot of sources to case studies, case history, et cetera. What that will do, then it goes to our entire, our operations team. We have people coordinating, reviewing it. We have people putting it in the right paperwork and et cetera, putting the report together. It's reviewed by our CPAs 4 times. And, once all that is done, then it's given back to you, the owner, which you can now take that report, which will produce, like I said, a 90, 100-page report, but at the end of the day, producing a 1-page updated depreciation schedule. And that's what you need to put into your tax filing.
And then so as the investor, you would just take those reports and hand them to your own accountant?
Exactly. And they'll know what to do with the depreciation schedule. And we have a whole team, like I said, of the engineers, the accountants, specifically on board to liaison with your accountants, to make sure we're understanding this. It's pretty straightforward, but we definitely have times where there are questions. What's the property value? What's going to be the land allocation? How can we add certain things to the basis, certain closing costs that weren't part of the original depreciation basis. So there's a lot of things that can go on, and we have conversations like that with the accountants, make sure everyone's on board.
You make it sound so easy.
It is. It is. It really is. It's really so easy. I'm going to admit there's a fee involved. Okay. It's not free, the whole thing. We charge a service fee for the actual study, nothing to do with the potential, with the contingent to the tax savings. So it's a flat fee, one-time fee, usually somewhere between, depending on the size and the scope of work of the property, anywhere from $4,000 to $10,000, somewhere in that range. Usually, on the lower side, unless it's a much larger property. And that's, like I said, a one-time fee. Doesn't matter if you're getting $100,000 of tax benefit or $100 million of tax benefit. The fee is going to be the fee based on the scope of work.
That's awesome. So I got to ask, when's the earliest we can involve you in the cost segregation, like as far as acquiring the property?
Yeah, so the earliest time is really even when you're under contract. You're doing the underwriting. You want to see what it's going to look like, what the potential returns are going to be for your investors. it's a great thing to do. Like I said, we do that. It takes a couple days for us to turn around this feasibility analysis, like an upfront report. That's a lot of people reach out to us once you go under contract. You know already what the property is. You're planning on closing. You can get it ready to go. And so once you actually acquire the property, once you close, you can get the study done. It's going to be ready to go for the following year's taxes. And you don't have to rush it right before tax season.
On the flip side, let's say I've owned a property for 5 years. I've been depreciating it over 27 and a half years.
Mm-hmm.
Would I still be able to reach out to a company like Madison and do a cost segregation study? And how would that work?
Yeah. So it's something you can actually do. Is one of the best benefits of cost segregation is you can get the benefits retroactively. So if you've been depreciating a property straight line, you've been doing it that way for however long, what you can now do is what's called a look-back study. Without amending any tax returns, you can now go ahead and recapture basically the missed depreciation that you should have taken from that accelerated depreciation over the past 5 years in your example. And we'll do a report at that point, and you're basically going to get a huge chunk in that first year, similar to the bonus depreciation where you get a huge chunk in the first year. And again, no amending tax returns. What we're going to do is file a form called 3115-3115, and that just goes along with your tax returns. Makes that adjustment.
It sounds like cost segregation only has positive things. Are there any risks to this? Like, is there any kind of downside that maybe a cost segregation company could mess up when they're filing?
Yeah, obviously, like everything, there's risks. Okay, everything in life has risks. Walking out of your door has risks, but it's seemingly a very small risk. So the biggest risks in doing a cost segregation study is getting it done by someone who's not qualified. Okay, that's the biggest risk. Someone who's not experienced. The firms that are out there, in my opinion, again, I don't know anyone besides actual inside, besides Madison SPECS, but I assume the large firms that are doing this have the experience. They're following the cost segregation audit techniques guide, which is a part of the Internal Revenue Code. Okay, you can check out the tax code, check out the audit techniques guide, and find out what needs to actually go into a quality cost segregation study in order for it to pass an audit. So we make sure that all these boxes are checked every single time, and we stand behind our work. So that's really important to make sure that you're not just getting it done, but you're getting it done by experts, you're getting it done by people who have the experience, and they'll stand behind their work in the event of an audit and have that experience.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today.
So I want to take this a little bit of a different direction. I know a lot of investors invest in real estate out of their IRA accounts. And what I want to know is with a Roth IRA, where the money you put into the account, it's already been taxed, and then all of the earnings are tax-free. Are you really going to get all of the tax benefits if you're investing out of a Roth IRA? And like especially with cost segregation, where you're potentially saving hundreds of thousands of dollars in your taxes? Or would it be best from a tax perspective to invest with another vehicle?
Yeah, so it's a great question. Roth IRAs obviously have the advantage you can invest in real estate from them. It can be advantageous if it's done properly, but you're not going to get the tax benefits because, like you mentioned, it's tax-free already. It's not being taxed. So you're not going to get the tax benefits. Depreciation will not apply to it. So if you're looking to invest in a deal because of cost segregation and you're investing from a Roth IRA or from a solo 401k that's not going to have those tax benefits, it's kind of a waste of energy from that perspective. However, it still may be beneficial because in the end of the day, you're going to want to look at where can you invest your own money, your own capital to make the best returns. So regardless of the tax, the tax benefits I always say is like an icing on the cake. It's great. But again, you don't want to invest in a property or invest in any type of vehicle just for the tax benefits. You want to make sure that you're getting returns on your capital. You want to make sure that it's safe. You want to make sure that it's going up in value. Instead of the tax benefits, again, are like icing on the cake.
And then so with other retirement accounts, like a traditional 401k, let's say you were to enter a deal with cost segregation, are you able to take the depreciation from inside that account and apply it to income? Like maybe you own real estate outside of the IRA, or is it stuck to just the income generated in that IRA?
No, so that's actually a good question. So in general, the income coming in for any properties, okay, like we mentioned before, is called passive income, right? And the depreciation is going to be used and allocated and can be used against any of that passive income. Okay, so it's not limited to one property. Each property to its own, the depreciation from that property for itself, it's actually all looked at as a grouping together. So if you have passive income from one property from just cash investments, and you have depreciation from that, it's going to be used to offset that income as well as the income from other properties as well.
So meaning like other properties outside of the IRA, like maybe in your personal name?
Yes, exactly.
That's awesome.
There is still going to be benefit, but again, it's not like your standard cookie cutter type of investment.
So these are probably all things you would need to consult with your CPA about to properly plan.
Of course. That's an excellent point. I'm just going to repeat that because never invest in an IRA or take your IRA because some salesman is trying to sell you a plan, right? To do that with, make sure you're discussing this with your CPA because there are many, many different ramifications that can come about just by investing through your retirement accounts. So you want to make sure that you're planning properly for all those things and not just get the bells and whistles from the fact that you're going to be saving on one thing when in fact it can come back to bite you later on some other end.
I wanted to know, what size property doesn't make sense for cost segregation study?
Like we mentioned before, it's proportional to the amount of property that's in there. It's proportional to 5-year, the stuff that's accelerated. So my basic rule of thumb is any property purchased for over $1 million is usually a no-brainer. There's like so much tax benefit there. It almost always makes sense. Under $500,000, I don't recommend it almost ever. So it's that kind of gray area between $500,000 and $1 million purchase price where it still can be beneficial and it's really more subjective to the situation of the owners of the property. What's going to be the benefits? Can they use it? Do they need it? In some cases, they'll have a capital gain from somewhere else and they want to use depreciation to help offset that. So it's going to be worthwhile to get it done.
We're coming up on time, so we wanted to move over to our Fast Five. These are the same 5 questions we ask every guest who comes on our show. So are you ready?
Awesome. Let's do it.
So if you had to start all over again and you were in your early 20s, what would you do differently to grow your business?
You don't think I'm in my early 20s now? The white hairs that gave it away?
You're probably in your 30s. That's what I would put you at.
I'm turning 40 next month, so I'm pretty close. But what would I do differently? I would just educate myself as much as possible and apprentice with someone who has been doing it for a long time. So just stay side by side with someone who is going to help walk me through the process.
How do you see young professionals adding the most value to experienced operators in this space? I guess if they were to be an apprentice.
There's a lot of things that millennials and young professionals may know about technology, may know about certain types of social media or different things that can really add value that maybe older people had not grown up with and has experience with and can add different benefits in that way. So, I think always be open to what the younger generation has to offer.
Completely agree with the technology and social media aspect. What's the biggest mistake you've made in your career and how have you since adjusted your business?
The biggest mistake is going with my desires over my gut. Okay. And so kind of going after the heart instead of after the head. So I'll just give one example of a case where, I thought a deal looked a great deal and I had a colleague who had recommended it didn't look good. Didn't look like a good deal. Like the guy, the sponsor was not straightforward. It's not going to play out. It's not worth it. But the money looked so good, right? The deal looked like it could have been great. And I just went with it regardless of the head saying, don't do it. It's not worth it. The heart saying, let's go it. It's going to be good. So I think that's the biggest thing. You always have to listen to the voice of reason and you have to learn the hard way. The voice of reason is always going to win.
Yeah, the School of Hard Knocks has definitely been in our lives before. What's been your favorite way to incorporate technology or social media into your business nowadays?
So I love LinkedIn. That's my biggest platform. I'm huge on LinkedIn, and I'm all into it because it's much more professional and relatable. It's social media. It's very similar to Facebook, and there's a lot of content being shared. There's a lot of connections being made, but I think it lends to a much more professional kind of environment. And I think it's like a huge networking event all the time. So you can network with people across the world. Doesn't matter where they are, all over the States, and I've done tremendous amounts of business just through that platform.
So do you have a favorite book that you would recommend to our listeners?
There's so many books. I highly recommend, if you haven't read it, Gary Vaynerchuk's Crush It or Crushing It. There's two different books, right? Crush It and Crushing It. Crushing is the sequel, but they're both phenomenal ways about how to use social media and how to just get out there, get out of your comfort zone and grow your business.
Yeah, we've been reading a lot of Russell Brunson's books, the .com secrets, and it's another great way, just kind of, it's all those marketing things that really help grow the business. So I want to thank you, Yonah, for your time. How can our listeners get a hold of you?
So you can find me on LinkedIn. That's the best way. You can reach me on my email, direct email, yweiss@madisonspecs.com. So it's the first letter of my first name, last name, Weiss at Madison SPECS. And give me a call anytime, 732-298-9002. I appreciate you guys for having me on. It's been great, and I appreciate what you're doing, and I wish you tremendous success with all your new endeavors.
Thank you. I appreciate that. We look forward to hopefully having you back on.
Okay, sounds good, guys. Thank you.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to kronosinvestmentpartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at kronosinvestmentpartners.com.